Warning: Why Wall Street Just Bought Your Basement, the 2026 Storage Trap. The lock clicks before he finishes the sentence. His code turns red. A printer down the hall spits out an auction notice with his unit number on it. On his phone, an email. Rate adjustment effective immediately. $20 more this month. $40 next. He stares at the corrugated door and does the math in his head. The crib, the boxes of tax records, his mother's china. Meanwhile, somewhere far away, a quarterly call celebrates pricing optimization. Problem: a quiet second rent on your past. Urgency: the code turns red at 12:01. Promise: we'll show the playbook and who profits. Solution: simple moves that cut the meter and push for rules. We need to go back to the moment America quietly lost its basements. The basement disappears. How housing created the storage boom. 3 moves in 5 years. That's the pattern Sarah and Marco fell into after their second child. Each apartment tour promised clever storage. A linen closet that fit 2 towels, a pantry the size of a shoebox, bonus cabinets, over the washer if you didn't mind a step stool. The rent rose every renewal, and each time they trimmed coats, old textbooks, the lamp from their first place. When they signed a 12-month lease in a newer building with glossy amenities but no real storage, the leasing agent slid a brochure across the table. Resident discount at the storage facility down the block. Temporary, they thought. 2 years later, the payments are auto-drafted like a utility. Get this, basements used to be assumed. In starter homes built mid-century, you got a basement, a garage, sometimes both. As land prices climbed and financing cheapened square footage above ground, developers shaved what buyers couldn't see in a walkthrough. You kept the quartz counters and lost the deep closets. Smaller lots, tighter footprints, and a sales script that swapped utility for lifestyle. Meanwhile, HOA rules quietly banned sheds, curb clutter, and anything that looked like storage. Problem clear. While that was happening in the suburbs, cities chased density and rent growth. Micro-units appeared with Murphy beds and cabinets that stopped short of functional. New builds leaned into aesthetics over space. Leasing offices printed floor plans that favored light over lids. To compensate, another line item entered the move-in budget. A 5 by 10 unit 5 minutes away. The math turned ruthless for renters. Moving every 12 months isn't just a truck and a Saturday. It's paying to keep life intact between apartments that never line up perfectly. A month of overlap becomes 3. The storage contract bridges the gap. And even when the move settles, the unit doesn't. The new place still lacks closets. The stroller the toddler outgrew might go to the next baby. The box of tax records can't be tossed yet. The rent increase notification arrives, and the storage payment barely registers. Smaller than the Netflix, certainly less painful than first and last month's rent. Developers understood incentives. You can't build larger basements on a pro forma that's measured in sellable square feet, especially when financing rewards amenities that photograph well. A gym sells faster than an 8-foot closet. A rooftop deck beats a garage. Fees replace space. Pet rent package service. Storage lockers in the hallway that hold a suitcase and a broom. A rented unit down the block fills the gap and doesn't weigh on the building's yield. From a distance, a macro shift was underway. Fewer homeowners, more renters, shrinking footprints, rising mobility. Wages didn't track housing costs, and families carried more life transitions. Divorce, downsizing, caregiving. Each one a spike in the need for temporary space. Temporary kept stretching. A 2-month bridge became 6, then 12. The $79 intro rate turned into $119 after the promo ended, then slid to $137 with a polite email about market conditions. Meanwhile, something else was happening across town. Older houses with generous basements became hot renovation targets. Finishing a basement meant a media room, a guest suite, an office. The leftover shelves where holiday bins lived transformed into drywall and recessed lights. The storage function disappeared behind a better appraisal and a higher property tax bill. The things that used to sit under the stairs needed a new address. Sarah and Marco's microstory kept accumulating little decisions that hardened into a bill. When her dad passed, 3 banker boxes of paperwork and a battered tackle box joined the unit. When their building switched to smart lockers for packages, they lost the corner of their closet they'd used as a buffer. When their landlord announced a renovation and offered them first dibs on a fresh unit at a higher rent, they moved upstairs for the air conditioning and kept the storage because we'll deal with it after school starts. What nobody told them, and what their budget didn't, flag, was how sticky stored things become once the door closes. Every visit is a negotiation. Do you spend an evening sorting, or do you tell yourselves you'll do it in 2 weeks? 2 weeks turns into next month into after the holidays. The debit runs, the unit stays. Zoom out, and you see why an entire industry slid into this scene. Households traded owned space for rented lifestyle, and the cost of keeping life's overflow shifted from mortgage to subscription. It's tidy for everyone except the person paying. Developers hit their numbers, buildings market wellness instead of closets, and families outsource space to a keypad and a rolling door. Here's where the housing story collides with finance. Once Americans started renting space for their own things, that monthly drip looked like something else on a spreadsheet. Predictable cash flow. Small units multiplied across neighborhoods, and temporary behavior hardened into habits portfolios could model. A basement lost in a floor plan became a unit gained in a REIT's rate base. While that was happening in Sarah and Marco's hallway, a different decision was being made in a glass conference room far away. Investors didn't need to convince anyone to love storage. They needed families to keep moving, keep downsizing, and keep paying to bridge every life transition. Basements weren't coming back. The bill was, and the people who owned those metal doors were ready to scale the gap. The perfect anti-tenant asset. Why Wall Street loves storage. From a finance lens, storage looks like it was engineered in a lab. No kitchens to flood, no boilers to fail at 2 a.m., no families to relocate if something breaks. A rectangle of corrugated steel, a keypad, a camera, and a lease that reads more like a parking ticket than housing. If you miss a payment, the lock changes digitally. If you don't cure the balance, the statute unlocks a fast lane to auction. There's no eviction court, no habitability claims, no rent board. For investors, that legal asymmetry isn't an accident, it's the edge. Operating costs tell the same story. Minimal plumbing, HVAC only where the manager sits, 2 people where an apartment complex might need 20. Public storage has told investors that direct operating margins hover around 79% at scale. That's the kind of number that draws capital out of offices and malls and into metal doors. In a downturn, storage often performs better because people move, downsize, or pause life decisions, and they rent a unit to buffer the chaos. Countercyclical becomes a line item in a pension fund's pitch deck. Now put this next to the rollout map. For decades, the business was fragmented. Thousands of mom-and-pop sites off the highway, hand-painted signs, month-to-month cash boxes. Then cheap money arrived, and a few big names started stitching the map together. Public Storage and CubeSmart kept buying. Extra Space didn't just buy, it merged with Life Storage, creating a coast-to-coast machine. Private equity joined from another angle. Blackstone took Simply Self-Storage and turned it into a scaled platform, the kind lenders and pensions favor. Each deal added doors, data, and local leverage. Urgency. Consolidation centralizes the switch that sets your bill. REIT math sharpened the play. Storage real estate trusts don't sell a story about vibes. They sell a story about NOI, net operating income, per rentable square foot. Grow rentable feet, squeeze more from existing customers, keep costs low, and pay dividends quarter after quarter. Index funds hold shares automatically. Pensions buy for the yield. Your 401k drips cash every time a rate letter lands in someone's inbox. Here's the kicker. Storage's customer isn't treated like a tenant. Legally, you're more like a licensee with property at a warehouse subject to a lien. Miss the due date and the timeline starts. Late fee, overlock, notice sale. The process is codified in nearly every state. That speed isn't a side effect. It's the reason storage avoids the drag that makes multifamily unpredictable. No months-long non-pay scenarios, no rolling arrears, no courtroom roulette. Inventory refreshes itself through default. And while those units look identical, the pricing isn't. Behind the front desk sits AI-driven revenue management software that reads move-ins, move-outs, search traffic, and neighborhood seasonality. It toggles teaser rates up and down to fill just enough units at the lowest possible discount, then pushes the existing customer rent increase once you're settled. ECRIs, those midstream bumps, often run north of 10% a year. That line alone is why Wall Street loves this asset. New customers don't make the pizza. Existing customers buy the toppings forever. Promise, expose the algorithm so you can push back. The human part is where the math locks in. People store sentimental things. They underestimate the hassle cost of moving them. Even when budgets get tight, the unit feels too small to matter and too annoying to solve. That stickiness gives operators permission to ratchet. They don't need to double your rent. They need to bump it a few dollars, a few times, until the annualized yield hits the model. If someone finally leaves, a promotion backfills the door within a week. Scale supercharges it. Once extra space absorbed life storage, pricing could be coordinated across micromarkets. A wait list here, a promo there. Shift a few dollars between neighboring sites and you manufacture scarcity without pouring a yard of concrete. Blackstone's platform advantage adds a different lever. Cheaper capital, better data, and vendor terms small owners can't touch. The spread drops straight to dividends. There's one more lever investors admire, the fee stack. Admin charges, lock sales, mandatory insurance offers at the counter. That last one is under legal scrutiny. Public Storage is fighting a 9-figure class action over alleged insurance tying. But even without it, the miscellaneous lines add high-margin dollars that don't require new buildings. When debt costs rise, those lines cushion the squeeze until the next rate case, because in storage, rates are just emails, not hearings. All of this turns a local shed into a financial instrument. You can model move-in velocity by school calendars. You can forecast delinquency by zip code stress. You can hedge rate risk at the corporate level while the site manager sells boxes by the register. And crucially, you can do it without the political blowback that trails apartments. No one protests a storage rent hike at City Hall. Back in Sarah and Marco's hallway, that pricing optimization, line on a call translates into $20 more this month, $40 next. In a boardroom, it shows up as guidance maintained. For the portfolio, it's stability. For households, it's permanent rent on space they used to own for free, converted into yield by a business that rarely has to meet a tenant in court or fix a broken boiler at midnight. That's why Wall Street loves storage. The doors click, the cash clears, and the metal hardly ages. The roll-up machine, how REITs consolidated Main Street units. While Sarah and Marco were taping another label on another banker box, a different kind of label was changing across town, quietly in ink. A deed would flip. The sign out front might not. Same orange doors, same manager's name on the window. But the money behind the padlocks was no longer local. The playbook started simple. Call the owner of a 300-unit site off Route 9 who built the place in the 90s. Offer a price that felt like retirement. Promise to keep the brand they'd painted by hand. Close fast. Then swap the back end. Centralize call centers. Port the leases into a corporate system. Turn on the pricing software. The corrugated doors didn't move an inch, but the rates did. Public Storage had been running this script for years. Extra Space ran it faster, and then did something bigger. It didn't just acquire. It merged with Life Storage, stitching 2 national maps into one. Overnight, micromarkets that once had 2 competitors became one network with a shared dashboard. That's how a waitlist on the east side can justify pulling a promo on the west, with a keystroke in a different time zone. Private equity arrived with a version built for speed. Blackstone bought Simply Self-Storage, not to dabble, but to platform. Platforms don't own one site, they own a system. They bring debt relationships that cut basis points, vendor contracts that shave pennies off locks and boxes, and a data spine that learns how often a college town churns in May versus a military town in June. The mom and pop who trusted a notebook and a gut can't compete with that. Research integrated. Blackstone is platform builder, not just a passive owner. Here's the twist that keeps the neighborhood feel alive, the local illusion. Consolidators routinely keep the old name on the fence. They keep the manager, too, because she knows customers by first name and who's late by Friday. But the rate letters don't come from her anymore. They come from a revenue team 3 states away, armed with occupancy targets and seasonality curves. Community at the counter, consolidation at the top. Cheap money poured accelerant on the model. For a decade, borrowing costs made it painless to lever a 6 cap into an 8+ return once ECRIs and fee stacks were layered in. Deals were structured in clusters, by 3 in a 15-mile radius, add a 4th, then rationalize the staff. 1 roving repair tech instead of 3. 1 district manager instead of 5. The savings looked like efficiency. They showed up as margin. Meanwhile, the software made the whole thing hum. Once acquired sites fed data into a single brain, patterns emerged that one operator alone couldn't see. Which zip codes tolerated a $6 bump without calls? Which funnels, Google Ads, drive-by, apartment referral, converted longer-staying customers? Promotions were no longer a whiteboard special. They were A/B-tested campaigns. The intro rate on Main Street wasn't a guess. It was a controlled experiment. Sellers often believed they were handing off to a caretaker who would invest in roofs and doors. And to be fair, the new owners did pave lots and install security cameras because a safe-looking site rents faster. But the real investment was in the switch that controlled price. Once that flipped, the timeline compressed. 90 days after close, existing customer increases were scheduled. 6 months in, ancillary fees were harmonized. A year out, the site's performance matched the model that justified the purchase. Not every roll-up was smooth. Oversupply in Sunbelt boomtowns made some clusters fight each other for move-ins, free months stacking like coupons. Consolidation insulated the biggest players. If Extra Space owned 4 of the 7 sites at a congested interchange, it could decide where to bleed and where to harvest. A promo here, a pause there, average yield intact. Small operators caught between them couldn't afford the chessboard. For customers, the shift showed up as sameness. The website looked familiar across brands. Insurance offers sounded identical. The late fee ladder matched down to the day count. That wasn't coincidence, it was standardization. Once a practice proved profitable in one market, it became doctrine in 50. The speed of copying increased with every acquisition. Regulators didn't blink much, because no single portfolio crossed a monopoly threshold within a city the way a cable franchise would. Storage is atomized. A 3-mile radius defines competition. But if 3 companies own most of what's inside that radius, they don't need a conference call to align. They need the same software reading the same weather and the same demand bulges. The outcome rhymes on its own. In the background, index funds kept buying the REITs, pensions soaked up the yield, and the dividend machine reinforced the next deal. Guidance promised stable growth. Acquisitions made it true. That flywheel only needed one thing from the street level: predictable bump tolerance. The roll-up delivered it by turning scattered sheds into a coordinated grid. Back in the hallway, Sarah and Marco never saw a press release. They saw a new logo on the receipt and a slightly different font on the email telling them their market rate had been updated. Unknown to them, across town, a closing table clicked. Another unit folded into a portfolio. The manager smiled and taped up a new ownership, same great service sign. Behind her, the pricing screen refreshed, and the machine moved on. The algorithm of scarcity, dynamic pricing, and behavioral lock-in. From the counter, it looks like a friendly discount board. From the back office, it's a dashboard. Move-ins, move-outs, search clicks, call volume, neighborhood seasonality. Everything lands in an AI-driven revenue management system, RMS, designed to tug one lever at a time. The goal isn't a full house. It's the right mix of paid doors at the highest possible average, with just enough vacancy to keep the promo faucet open. Like airlines and hotels, the price you saw this morning might not be there by lunch. Here's how it works in practice. The system watches occupancy inch toward a threshold, say, 88% on 5x10s. Intro rates drift up $5. If inquiries soften, a weekend-only promo appears on the site, but not on Google Ads. If a nearby competitor fills, the teaser shortens from first month free to first 2 weeks half off. Every tweak is an experiment, measured by length of stay and likelihood you'll accept a raise after 90 days. That second number matters more than the first. Once you're in, the real machine starts. Existing customer rent increases, ECRIs arrive like weather. $10 here, $12 there, frequency tuned to your zip code's churn history. The system learned that most people don't move out over a small bump. It learned that sentimental items extend stays. It learned that a Friday email pushes fewer cancels than a Monday. It learned that each additional trip you make to the unit increases your tolerance for the next raise. None of that is personal. It's math smoothing your resistance into yield. Scarcity isn't just price, it's timing. The software coordinates waitlists to keep the sense that the last 10 by 10 in your preferred building is nearly gone. That might be true 4 floors up, not on your corridor, but the banner works. Targeted promo codes hit the inboxes of prospects who clicked directions twice this week. Move-in deadlines shorten at month end, then lengthen on slow Tuesdays. Calendar becomes a pricing tool, the same way seat maps do on a route that's almost full. Sarah and Marco feel it without seeing it. The $89 intro rate that sold them their unit came with a cheerful yellow star. By month 4, it quietly flipped to $119. 10 months in, $157. Each bump lands just below. A threshold that would trigger a Saturday with tape and a truck. The system knows the hassle cost of moving a crib and 4 banker boxes. It banks on it. Behind the knobs, operators talk about stickiness. Sentimental attachment plus hassle equals inertia. Add life transitions, new job, new baby, a parent's health, and you've got reasons to postpone the cleanup trip. Delay is a revenue line. ECRIs can exceed 10% annually across the base and still post low churn. A few leave. Most sigh, grumble, and let autopay ride. Parallel to pricing, access becomes a lever. Smart locks and apps make enforcement instant. Miss a payment and your code stops working. Pay on your phone and the door blinks green before you reach it. 2 clicks between overlock and forgiveness. The ease lowers confrontation and shortens delinquency windows. The model counts on recoveries measured in hours, not weeks. The data edge compounds with scale. After extra space absorbed life storage, thousands of micromarkets fed one brain. A heat wave in Phoenix nudging 10 by 20 demand? The system sees it first. A university calendar driving churn in Madison? Rates nudge up a week before finals. Blackstone's platform adds cross-portfolio signals, migration, housing turnover, local layoffs, that predict which neighborhoods accept a $6 nudge without a spike in calls. What used to be a manager's hunch is now a curve. There's a softer pressure, too. The front desk scripts pair empathy with exit friction. Ask about a raise, and you'll hear about operating costs and security upgrades. Ask to move out, and you'll be offered a smaller unit, downshift without leaving. That keeps doors paid and move-outs recaptured as move-downs. Downsizing is still stickiness. It's also another set of fees. Promotions aren't generosity, they're funnels. A 1-month free teaser filters for people likely to stay 6. A half-off second month nets the price-sensitive who churn early. The RMS tags each segment. Later, the raise cadence differs. High-tech renters get earlier bumps. Coupon chasers get slower increments, but more fees. 2 customers, same hallway, different journeys. Not discrimination, segmentation. What nobody in the hallway sees is how little the system needs from any one person. It doesn't have to squeeze Sarah and Marco hard. It has to nudge thousands lightly, reliably. A few dollars across a million doors becomes guidance met, dividend paid. If a micromarket box, a neighboring site takes up the slack. Scarcity is managed across a grid, not a building. At the end of the quarter, the algorithm's success reads like smooth lines. Average length of stay up a week. Effective rent up 3%. Delinquencies down half a point. No drama in the numbers. The drama stays in the hallways, where codes turn red at 12:01, emails arrive at 12:03, and a family postpones one more Saturday because life is busy. The software learned default as a business model. It writes it into late the price, fees, liens, and auctions. The first missed payment doesn't feel like a crisis. It feels like a calendar mistake. A week later, the bill carries an extra $15 labeled late. By day 10, a certified letter goes out with language that sounds official because it is. The account is in default. A red overlock appears on the latch. Your code still opens the gate, but not your door. What happens next is scripted down to the day count in nearly every state's self-storage lien law. This isn't landlord-tenant territory. In storage, you agreed the facility has a lien on whatever you put inside. That gives the owner a fast lane. After a set number of days, a second notice arrives. Pay the balance plus fees or your property will be sold. The letter includes the itemized stack. Admin charges, lock fee, lien fee, certified mail fee, sometimes a pre-auction fee. Miss the cure date, and your name moves to a list that will be advertised in a legal notice few people ever see. 30 days ago, you were a customer. Now you're inventory. Operators don't improvise this. The timeline lives inside the software. On day X, an automated text. On day Y, the overlock is flagged. On day Z, the sale is scheduled. A manager's screen shows a queue with colored bars, green for cured, yellow for likely, red for push to sale. Each step adds revenue. The late fee is high margin. The lien fee even more. The lock they sold you for security now earns again as a drill and replace line. Insurance sits in the middle of this machine. Many sites offer policies at the counter, framing them as prudent. Some allegedly require it. Public Storage faces a class action seeking roughly $100 million over claims it tied mandatory insurance to rentals. Regardless of brand, the policy small print often excludes the very losses renters assume are covered: vermin, mold, and moisture. When a claim is denied, the unit still owes. The fee stack is indifferent. Research note: this lawsuit centers on alleged tying, not a final judgment. What nobody in the hallway sees is how default behaves in the model. A portion of accounts rolling 30, 60, 90 days is assumed. Those balances accrue fees that may never be fully collected, but the process yields money even before a sale. For the units that do cross the line, the auction is not a TV show. It's a clearance mechanism. The goal isn't to prize the rare antique. It's to zero a door and reset it for a new customer at a higher rate. Auction day is brisk. A third-party platform lists units with 5 photos and a lot number. Bidders are resellers who know how to move bulk. The facility recovers only what's allowed by statute: rent due, fees, disposal costs. If anything remains, it's supposed to be held for the former renter. Often, there's nothing left. The rest, the baby clothes, the papers, the tackle box, turn into work for someone with a pickup and a weekend. Meanwhile, the software logs a success. Delinquency cleared, door available, ECRI opportunity restored on the next occupant. The cycle is tidy. A fraction of customers will default, a sliver will be sold, the remainder will pay fees or catch up. At scale, that pattern stabilizes cash flow. It's not an accident. It's a feature the industry refined against the friction that slows apartments. This is where the human stories go quiet. A renter laid off in June stretches a week, then 2, planning to catch up after a contract starts. The lien notice lands the same day the new job's onboarding slips. A grandmother keeping her late son's belongings misses a certified letter because she works doubles. A small contractor's tools sit behind a red lock after a slow month. Each believes it's temporary. The clock says otherwise. Operators will tell you procedure exists to protect everyone. Clear rules, published timelines, lawful sale. And that's true as far as it goes. But the incentives sit behind the glass. The cadence of fees, the low cost of enforcement, the ability to convert a personal crisis into a cleared ledger without a judge. It's efficient because the law makes it so. Alaska is the only state that never passed a storage lien statute. Everywhere else, the corridor belongs to the owner once the calendar flips. If the algorithm is a whisper, default is the click you hear. A code turns red. A notice prints. A unit becomes a lot. And somewhere on a slide deck, the line labeled bad debt looks tame, because even in loss, the model found a way to earn. From keys to apps, automation, kiosks, and remote control. The counter used to be a bell and a pen on a chain. Now it's a touchscreen kiosk glowing at midnight. A tired voice on the speaker walks you through a lease while a camera matches your face to your ID. No manager, no closing time, no chance to ask why the intro rate isn't the one you saw on your phone. Convenience sells the door after hours. It also moves staffing offsite and control to a dashboard. Call centers replaced front desks. One rep can manage 6 sites from a headset, reading a script tuned by the same software that sets prices. Need a lock cut? File a ticket. Need a cart? Press star. The human who answers may be 3 states away, but the system that approves exceptions lives even farther, in a server rack measuring risk, fraud, and opportunity. The point isn't service, it's throughput. Smart locks close the loop. Your gate code is a variable, not a key. Miss a payment at noon, and your app turns gray by 12:01. Clear the balance on your phone, and the latch blinks green before you reach the hallway. That instant flip squeezes delinquency windows from days to hours. No confrontation, no come see the manager. Just a door that either obeys or refuses. Enforcement becomes as simple as toggling a field. Telemetry crept into everything else. Door sensors log how often a unit opens. Corridor cameras timestamp visits. Climate monitors flag back-of-house costs in real time. In a portfolio meeting, a map lights up sites with abnormal usage. More trips than expected, later hours than normal, correlated with churn risk or opportunity to upsell 24-hour access. Data replaces intuition and creates new products out of basic rights. Leases went digital with a purpose. E-sign at the kiosk or on your phone, and the terms become code. Autopay defaults on. Arbitration clauses sit where eyes glaze. A box labeled Decline Insurance appears only after two other screens try to sell it. The path is optimized to increase attachment, rent, lock, boxes, coverage all in one flow. Once the signature stamps, a CRM tags you for welcome emails and the first ECRI calendar. Inside those CRMs, cross-sell scripts hum. Need boxes? The system suggests a bundle at pickup. Need a lock? The counter sells a branded cylinder, keyed to their drill bit. Moving supplies act like margin candy by the register. Low cost, high markup. The add-ons don't make the business, they smooth the quarter. When debt costs bite, small lines help hold guidance together. Labor changed shape. One roving tech now handles 3 properties' doors, cameras, and asphalt. Cleaners rotate by route, paid per checklist photo uploaded to an app. A single on-site manager covers peak hours, backed by a call queue at night. For investors, this isn't just cost-cutting, it's consistency. People are variable, scripts are not. The fewer decisions left in a hallway, the more the portfolio behaves like its model. Automation also hardens timelines. Overlocks used to wait on a person with a red tag and a ladder. Now the system schedules digital overlock the minute a grace period ends. If you dispute a charge, the workflow routes you to policy review. If you beg for time, the call center offers a deferment once per year, then triggers a lien letter anyway. Exceptions exist, but they're rare because exceptions don't scale. Promoters market all this as safety and convenience. Kiosks make move-ins easy. Apps reduce lost keys. Cameras deter theft. Some of that's real. People do rent at 1 a.m., and a code on a phone beats a rusty padlock. But convenience isn't the point. Control is. The same tools that simplify access make enforcement instant and labor light. They turn messy human friction into clean digital steps. Unknown to Sarah and Marco, their hallway is managed by a stack of APIs. The kiosk talks to the lease engine. The lease engine talks to the RMS. The RMS talks to billing. Billing talks to the lock network. A missed debit pings a webhook that tells a motor to refuse. A payment triggers the opposite. No one argues, no one fumes at a counter. The machine nods or shakes its head. Urgency reinforced. The enforcement window is now minutes, not months. For the portfolio, the outcome is tidy. Fewer staff, faster move-ins, tighter collections, higher margins. For households, it's something else. A relationship with a door that never negotiates and a system that never sleeps. The old metal key didn't care about guidance. The app does. And every tap feeds the model that writes next quarter's script. The capital flywheel, REIT dividends, private equity exits, and pensions. Follow the money from Sarah and Marco's hallway to the accounts that expect it. At the top sits a promise with a ticker symbol, stable dividends. Storage REITs sell reliability the way utilities do. Quarterly checks, modest growth, few surprises. That pitch lands with pensions, endowments, and the index funds inside your 401k. If the AI-driven RMS downstairs nudges 1 million doors by $6, upstairs the fund manager checks a box labeled coverage maintained. Here's how that flywheel turns. Storage REITs raise equity when deals are plentiful, borrow cheaply when rates cooperate, and deploy both into acquisitions or expansions. Net operating income flows up, less friction than apartments and far steadier than retail. With direct operating margins that can sit around the high 70s at scale, small improvements travel cleanly too. Cash available for distribution. Dividends reinforce the share price. A firm that keeps raising its payout can issue stock at a premium, buy more doors, and repeat. The machine eats scarcity and excretes guidance. Private equity runs a parallel loop on faster clocks. By regional operators at a multiple. Bolt on nearby sites. Install the same RMS, the same lock network, the same CRM. Squeeze costs, harmonize fees, lift existing customer rents. Once the storyline shows through the numbers, recapitalize. Either sell to a REIT hungry for accretive acquisitions or to another fund with cheaper debt. If rates spike, hold longer, milk cash, and market operational excellence. Either way, the exit rests on predictability downstream. Debt acts like an accelerant either loop can spray. When funds were cheap, leverage padded returns without rattling risk committees. Today, elevated interest costs nibble at spread. The fix isn't mystery. Nudge ECRIs a notch, trim staffing with kiosks, push ancillary lines, pause low-yield capex, and roll maturities into a window the board believes will be calmer. Because the story sold to pensions has two verbs: protect and grow. Storage, unlike offices, still protects. It grows if you keep the bumps polite. There's an irony baked into the prospectus. The same retirement money that shows up on Sarah's pay stub as a contribution cycles back as pressure on her storage bill. Your plan owns REIT shares through an index. That index needs distributions that keep climbing. The portfolio manager won't call a site manager to demand a $12 raise. They'll sit in a meeting and ask whether same-store NOI can advance 3 to 4%. The translation, one hallway over, is an email with market rate update. Blackstone's platform is the bridge between these worlds. It can acquire at scale, fund improvements more cheaply than regional banks, and unload into public markets when multiples cooperate. Simply Self-Storage isn't a story about one logo. It's about a chassis lenders understand. When the chassis hums, the exit multiple widens. Pension money wins twice, once on the fund's carry, once on the REIT's dividend. The family in the hallway pays once. Index ownership deepens concentration without a single phone call. As REITs grow, they swell inside market cap-weighted funds. A retirement plan buys the market buys storage. That passive bid steadies share prices, lowers equity cost, and makes the next acquisition simpler to pencil. A site sold by a retiring couple in June is packaged by September into a balance sheet that sits in teachers' pensions by December. Nobody voted on the lock fees. They were a line. Meanwhile, sell-side notes applaud constructive regulation and attractive supply-demand balance. Translation: no rent control, minimal permitting headaches, and neighborhoods that frown at new builds near homes. Scarcity created by zoning elsewhere props pricing here. When housing turnover slows, move-ins dip. When rates freeze buyers in place, downsizers need bridges longer. Either way, a portion of life continues to overflow. The flywheel counts on that human arithmetic. Promise, we'll show you how to break the drip and where policy can pull the plug. It also counts on invisibility. Storage sits outside lightning rod debates about shelter. No tenant unions, no rent boards, no televised hearings. That keeps the payout narrative clean. If a lawsuit about insurance tying threatens an ancillary revenue stream, disclosures address it and the model absorbs the hit while ECRIs carry the line. If debt markets tighten, a dividend grows by a penny less, not by none, because thousands of small bumps compound even under pressure. Watch the loop complete. A board approves a dividend increase. A pension actuary marks long-term assumptions unchanged. A retiree's monthly check clears. Somewhere, a kiosk lease flashes green at 12:05 a.m. A code turns red at 12:06. The capital markets call it resilience. The hallway calls it Tuesday. Beyond the metal box, parking, garages, and digital storage. Meanwhile, something adjacent started to feel familiar. The places you put your car, your bike, your bits. The same pricing logic slipped from hallways of corrugated steel into concrete ramps and cloud servers with the ease of a swipe. Start with urban garages. For decades, they were dusty cash boxes with a booth and a stack of validation stamps. Then the booth disappeared and a plate reader showed up. Overnight, curb space in garages turned into dynamic markets. Saturday surge near the stadium. Early bird discount evaporates at 8:59 a.m. The app warns only 3 spots left, even if level 4 is half empty. That number isn't a head count. It's a lever. Like storage, the goal isn't full. It's average yield per stall, tuned by event calendars and weather. Street parking joined the script. Cities outsourced meters to private operators on long concessions, trading upfront checks for algorithmic rate hikes. Lunch, rush, meter jumps. School pickup, another bump. In some deals, performance clauses let vendors nudge prices to hit occupancy targets without a public vote. The curb stopped being public space and started behaving like a portfolio. Microscarcity sold in 15-minute slices. Subscriptions crept in. Apartment garages began offering premium stalls with guaranteed proximity and higher fees. Office towers layered EV-ready surcharges on top of monthly parking, then sold the charger as an add-on with session fees that flexed by hour. It feels like convenience. It models like storage, fixed concrete, variable price, software in charge. Inside buildings, neat rows of wire cages appeared in basements and hallways labeled resident storage lockers. The brochure called them amenities. The lease called them addenda. For $40 a month, you got a 3x4 cage under a sprinkler pipe that once would have been part of your apartment. HOAs copied the move. A corner of the garage turned into rentable bike racks and strollers bays. What used to be a closet became a fee. The metal box moved closer and shrank. The rent stayed. Then there's the last mile trick. Parcel lockers popped up in lobbies and storefronts. Convenience again. But start adding the charges. Oversized package fees, after-hours access, subscription delivery boxes. Buildings that once accepted parcels as part of rent now monetize the square feet a box occupies for 24 hours. Even the act of receiving moves toward a meter. On the curb, the play got stranger. Smart loading zones rolled out with QR signs and apps you'll never download until a ticket hits your windshield. 5 minutes free becomes 2. Grace periods vanish into push notifications you missed. Enforcement blends with pricing. A late tap costs $40, payable on your phone. That isn't a fine, it's an upside line. Zoom out to bits, and the rhyme gets loud. The photos you meant to sort next weekend spill past your phone's limit at 3 a.m. A pop-up offers peace for $2.99 a month. That's a 5x10 for your camera roll. Next comes tiering, 50 gigabytes, 202 terabytes. You promise yourself you'll clean before the bump. You don't. The debit runs. Then family sharing, priority restore. Vault features with names that sound like safety and price like stickiness. The ECRI equivalent is a nudge from $2.99 to $3.49 and a footnote about enhanced security. Enterprise Cloud works the same way with bigger commas. Teaser credits pull you in. Egress fees keep you from leaving. Requests per second become a unit of rent. Architects call it data gravity. Finance calls it lock-in. Storage by another name lives on a server farm lit by LED, billed in 6-minute increments. Gamers recognize the pattern in a different skin. Save game slots, texture packs, season passes that keep access alive month to month. Parents see it in school apps upselling premium photo downloads of class pictures that used to arrive as prints. Small businesses meet it when their point-of-sale firm offers archival access for receipts older than a year. Another tick on a ledger that looks like rent from memory. The psychology is identical. Hassle cost plus sentiment equals inertia. Your wedding photos, your kids' drawings, the documents you might need for taxes, they're not leaving. Bits don't smell like a musty hallway, but they trap you the same way. Deleting requires time and certainty. Paying requires a thumbprint. And the capital sees it the same way. Parking concessions trade like bonds. Curb rights get securitized. Cloud providers report net retention like an ECRI chart for bits, expansion, add-ons churn. The permanent rent map keeps expanding. Atoms on the curb, cages in the garage, packets in a data center. None of it looks like a basement. All of it bills like one. Back in Sarah and Marco's life, the card statement tallies the conversions. Storage unit, building locker, garage pass, photo cloud, parcel locker, each small. Together, a second rent. The objects didn't multiply. The meters did. Service erosion, security, cleanliness, and the race to cut costs. The flyer says enhanced security. The hallway says otherwise. A light flickers above unit 314. The camera dome is dusty, tilted a few degrees off center since the last time someone bumped a ladder. The mop bucket is parked near the elevator, half full gray. A week later, a smell creeps under doors, cardboard that got damp, then stayed that way. When labor is shaved and routes lengthen, the first thing that thins isn't dividend coverage. It's bleach. Thin staffing shows up as time. Break-ins don't happen like the TV show, crowbars and a climactic reveal. They look like 20 minutes between patrols because the same roving tech covers 3 buildings. A roll-up door along the back drive sticks open after a delivery. By the time anyone notices, 2 units carry fresh dings, one has a missing lock, and the camera that should have caught the plate reflects a headlight glare instead. The report codes the event as undetermined. The insurance brochure on the counter says peace of mind. The policy exclusions page says vermin, mold, moisture, mysterious disappearance. When tenants file claims, the gaps widen. A musician opens a unit after a hot week to find cases swollen and felt linings damp. The climate spec on the website promised temperature control. The fine print didn't promise humidity. A grandmother boxes her late son's books, stacks them on a pallet like the clerk suggested, and comes back to speckled covers. The denial letter cites biological causes. The unit remains current. The rent still drafts. As-is becomes a shield. The digital lease puts it in a paragraph you clicked past at the kiosk. Storage at occupant's sole risk. It sits beside the arbitration clause and the venue selection you didn't notice at midnight. When you ask the call center why the lock hallway hasn't been cleaned, you're routed to policy. When you point to a camera, you're told to file a police report. The operator will cooperate. The responsibility stays on your side of the red line. Compliance lives on paper. Facility logs show rounds completed. Photos in the app show clean corners, cropped tight, time-stamped. The maintenance checklist says roof inspected, drains cleared, door lubricated. The day the storm rolls through, the same roof drips in a line that follows the seam where old flashing meets new. 3 units on the top, gross smell like a wet basement. The carpet remnants inside wick like candles. A month later, someone tapes a sign over the stain. Mind your step. Security can be theater, too. A new camera appears at the gate, bright and obvious. The blind spot by the side fence stays. Floodlights wash a lot nobody parks in. The alley where a contractor props the dumpster lid at night keeps its shadow. Theft reports are down. The manager says because incidents moved off-site into vans that leave before anyone asks for a code. The crime feels distant because the record says no forced entry. A cylinder lock drilled cleanly is not force. It's competence. Staff speak in scripts because scripts survive cuts. We take security seriously. We recommend insurance. We encourage pallets. When you ask for a second card on a Saturday, the answer is a QR for a wait list. When you flag a propped fire door, the reply is a nod and a note, entered into a ticketing system that ranks issues by impact to occupancy, not by risk. A missing bollard near the loading zone gets scheduled next month. A faded promo banner is replaced tomorrow morning. 3 units down from Sarah and Marco, a metalworker keeps surplus tools. One morning the latch feels light, the door rolls easier, and a wrench is gone. He checks the feed at the front desk. The clip shows a figure in a hoodie at 2:13 a.m., pixels shimmering where the face should be. The rep offers a case number and an email address. We understand your frustration. He pays his balance and buys a second lock. The people working these sites aren't villains. They're stretched. A manager cleans at closing, then drives to another property to meet a contractor, then answers the phone at home because the call queue overflowed. The roving tech patches what he can and logs what he can't. The incentives don't pay for redundancy. They pay for speed. In the quarterly deck, service erodes into ratios. Payroll as a % of revenue, maintenance per square foot, claim frequency per 1,000 doors. The lines look stable. The hallways don't. And inside those hallways, trust thins the same way the bleach did. Slowly, then all at once, replaced by a shrug and a habit of taking photos and local ownership. The door. The first town hall didn't look like a revolution. A folding table, a blown-up bill with 3 new fees circled in red, and a line of renters who'd never said a word at meetings before. A city council member asked what they wanted. The answers were specific, not grand. More notice before rate hikes, caps on how often existing customers could be raised, and a real human to contest a lockout. The ordinance that passed wasn't perfect, but it drew a line. 90 days notice for e-series. 1 increase per year. A hardship deferral without an overlock. While that was happening in one county, lawsuits formed elsewhere. The public storage insurance fight gathered stories that read the same. I was told I couldn't rent without buying coverage, followed by a denial citing mold or vermin. The class actions number, around $100 million sought, was less important than its allegation, tying a high-margin product to a necessity. Operators called the claims overblown. Judges let parts proceed. Discovery Pride opened scripts and conversion targets that look like upsell goals anywhere else, except here a late letter ends in a sale. Consumer protection offices started to notice patterns in lien timelines. Advocates pushed states to modernize statutes written in the 198s. A few wins landed. Longer grace periods required multi-channel notices, mail, email, text, and clear photo catalogs before sale so tenants could verify what was taken. Some legislatures added exemptions. Military deployments paused lien clocks. Medical crises qualified for temporary holds. The balance didn't flip, but the stopwatch slowed. Then came transparency rules. A coastal city passed a disclosure law with teeth. Sites had to display teaser rates alongside average effective rents for the past 6 months, list total potential fees on a single placard, and publish annual data on ECRI averages by unit size. Revenue managers grumbled. Customers finally saw that $29 wasn't anyone's real bill. Move-ins dipped for the most aggressive promos. Churn softened when operators hesitated to send a third increase. Local ownership pilots tried a different path. A community land trust in a mill town bought a small, underperforming site the REITs ignored. They didn't promise charity. They promised predictable. Rates set by a board that included renters, caps indexed to CPI, and lien procedures with a real hardship committee that met weekly. Defaults still happened. Auctions still happened. But the cadence changed, and the surplus funded youth jobs sweeping halls instead of a line under SG&A. Co-ops tested the model in a city where artists kept getting priced out. Members bought shares that granted discounted units and a vote on policy. The first meeting banned mandatory insurance, offered opt-in coverage at wholesale, and set a late fee ladder that flattened after day 10. The second installed humidity monitors and posted readings on the wall. Word spread faster than promo codes ever could. The waiting list filled with people who needed space, not a funnel. Municipal leverage showed up where public land met private deals. A port authority included guardrails in an RFP. No ECRIs above CPI +3, mandatory bilingual notices, and a requirement that any lien sale within 6 months of a declared disaster include pre-sale mediation. Bidders complained margins would compress. The winning proposal still penciled. The city traded a point of yield for quieter hallways. Enforcement mattered. Ordinances without staff sat on shelves. Cities funded small consumer offices with the power to audit fee practices, mystery shop teaser rates, and publish scorecards. One quarterly report became a local favorite. Which sites raised how often, which denied claims the most, which filed liens the fastest. Operators adjusted in public. Not all pushes worked. A proposed state cap on existing customer increases died under lobbying that warned of unintended consequences. A ballot measure to ban lien sales after a single missed payment failed by 8 points. Losses taught organizing. The next version carved out disaster windows, protected active duty military, and limited overlocks during extreme heat. It passed by 2. Back in Sarah and Marcos City, a second ordinance arrived a year later. Standardized hardship forms, one-click opt-outs for autopay, and a 24-hour cooling-off period before a digital overlock. It didn't lower their bill. It changed the terms of delay. Instead of a code turning red at 12:01, they got until midnight tomorrow. In a life held together by calendars, 24 hours is a lot. None of this broke the model. It reshaped its edge. Rate bumps still came. Auctions still clicked forward. But the distance between a missed debit and a lost crib widened. And in a few neighborhoods, the people behind the doors own the locks, too. Personal off-ramps, beating the storage trap. Start with a Saturday and a timer. 90 minutes, not a lifetime. Sarah and Marco learn it the hard way. You don't organize your life. You clear one shelf. Break the unit into 4 piles with an exit date on each. Keep for 1 year, keep for 1 season, sell/donate this week, shred/ditch today. Tag boxes with a date, not a feeling. Taxes till 2029, winter gear by November. Dad's Papers Review, July 15th. If the date passes twice, it moves down a pile. The point isn't perfection. It's momentum you can schedule. Solution starts here. Negotiate with algorithms the way they negotiate with you. Promotions roll like tides. Ride them. Move-in rates dip mid-month, midweek, and after the 5th when managers chase quotas. Call and ask for a reverse churn retention. Hint you'll vacate at end of term unless they roll you back to a new customer rate. Be specific. Quote nearby teaser ads and ask for a courtesy adjustment. If the agent balks, calendar a checkout for the last weekend of the month. The system rewards doors that don't go red. You'll often get a credit or deferral. Geo-arbitrage matters. Most price maps swing inside a 3-mile radius. Widen to 8. Independent operators, still out there between the big logos, often post flat rates, fewer fees, and humans who can authorize real exceptions. Ask 3 questions on the phone. How many existing customer increases in the last 12 months? What's your late fee ladder by day? Do you require insurance to rent? The tone of the answers tells you more than the numbers. Solution: Small moves that cut your second rent without drama. Write cleaner contracts. Decline autopay until you've read the fee table. If you must use it, set a calendar reminder 2 days prior so a low balance doesn't trigger a cascade. Look for the arbitration clause in venue. If you can't strike it, at least photograph it. Opt out of convenience add-ons, lock bundles, move-in kits, admin fees dressed as intake. Bring your own cylinder lock rated to the facility spec. If insurance is offered, shop a renter's policy you already hold. Add off-premise contents coverage, and skip the counter product with exclusions that read like your unit. Shrink the footprint with swaps, not vows. Downshift inside the same site, 10 by 10 to 5 by 10, once you've done 2 90-minute purges. Use the facility's cart as a forcing function. 1 cart per visit, 1 decision per box. Photograph heirlooms and keep a single anchor box per person. If you wouldn't pay $5 a month to keep an item, it doesn't belong behind a rolling door. Build a cheap redundancy at home. A $60 wire rack and 4 clear bins in a closet beats paying $140 to store winter gear across town. Underbed drawers take the place of the hallway cage your building added and charges for. Negotiate with your landlord for a key to the bike room instead of a premium rack. If the answer's no, a shared rack in a neighbor's garage can be worth a small stipend and a handshake. Try community options before corporate ones. Tool libraries, neighborhood, buy nothing groups, and church basements hosting seasonal swaps reduce the volume you feel responsible to house. A local makerspace will store a bandsaw for less than a unit will charge to keep 6 boxes of holiday lights. If you're in a co-op or HOA, propose a shared storage shed with transparent rules and a wait list. You're not avoiding rent, you're keeping it in the block. Plan exits the day you enter. Put your move-out date on the lease screenshot. Schedule the truck now, not later. Ask what constitutes notice, and give it before your first ECRI window. If life swerves, new baby, new job, ask for a hardship deferral in writing and confirm the overlock won't flip during that period. Who can approve that? Is a script breaker worth saying twice? When you must store, time it. Move in midwinter or midsummer when housing churn is low. Reserve online, not at the counter. Screenshot the teaser and all fee pages. Bring a second person. Decisions have faster when someone asks, why this, why now? Pair your 90-minute purge with a donor pickup appointment you booked last night. None of this makes the machine kinder. It makes you slipperier. You won't win every request. You'll win enough. And each dollar you don't send up the chain becomes a shelf you own again. Not in a REIT's rate base, but in your hallway, where the only algorithm is a timer and a Saturday. The Permanent Rent Society, when space becomes a subscription. Zoom out from one hallway, and you start to see the map. We used to pay once to own space, attics, basements, closets, a garage corner. Now the same square feet show up with monthly prices and auto-renew. Storage wasn't the start. It's just the place where the model is obvious. The deeper shift is that necessities have been rebuilt as subscriptions. Shelter split into rent and fees. Water learned riders. Mobility cells curb minutes. Memory lives behind a paywall. Financialization likes scarce things. The narrower the pipe, the cleaner the yield. So scarcity becomes a strategy, not a problem to solve. Permit fewer apartments. Charge market rates. Meter curb space. Surge for school pickup. Limit lockers in buildings. Sell cages in basements. Cap free cloud tiers. Nudge upgrades. Then add software to watch behavior and set prices just below revolt. Demand isn't noisy anymore. It's segmented and billable. Data seals the grip. Operators don't just know occupancy. They know the rhythm of a block. Who opens a door after midnight? Which phones tap a meter twice a week? Which households keep photos long past the tiny backup window? That data doesn't just predict price tolerance. It becomes a private map of microgeographies. 3 blocks here that always pay. A corridor there that churns in August. The machine learns who to bump and who to comp for 1 month because a lifetime value curve says it's worth it. And the social cost lands where life is already fragile. People don't rent units and lockers and cloud space because they want to. They rent because the periods between milestones got longer. Divorce, downsizing, a parent's decline, a kid boomeranging back for a semester. The stuff that doesn't fit in a transitional life moves to a door with a monthly meter. And once a subscription attaches to grief or delay, it's hard to cancel. The trap isn't just money. It's time. Every new subscription steals a decision slot you don't have. You'll clean the unit next Saturday. You'll purge the cloud the weekend after. Life adds 2 errands. The auto-debit stays. That friction is the business model. It turns ordinary delay into permanent rent while a board deck calls it stickiness. Meanwhile, capital compounds out of sight. REITs raise payouts. Funds exit platforms. Indexes deepen concentration. The same rotation plays out in adjacent arenas. Parking concessions that escalate without hearings. HOA amenities that used to be hall closets. Delivery lockers that charge because the building laid off the front desk. A city's smart meter that pings at 12:01 and fines at 12:06. Different wrappers, same math. We tell ourselves this is convenience. Sometimes it is. A scanner at the gate beats a jangly key. A cloud restore after a phone slip saves pictures you love. But convenience became the sales pitch for control. If a code can blink green instantly, it can blink red just as fast. If your photos live behind a password, they live behind a price change. The ease that removes nuisance also removes negotiation. There's a deeper irony. The more we compress our lives into smaller, efficient homes, the more we externalize overflow into markets with pricing power. We celebrate minimalism on the surface and rent the ghost of our square footage across town and online. The footprint shrinks. The subscription list grows. Basements turn into yields. Closets become cages. Albums become gigabytes. The house still looks neat. The bill doesn't. This isn't a lecture about stuff. It's a question about power. When space itself, physical or digital, runs through fee switches owned by a few firms who sets the terms of pause, grief, and memory, the answer isn't in platitudes. It's in code that locks a door, a lien statute that sells a crib, a paywall that holds a wedding photo hostage for $3.49 a month. It's in a dividend policy that expects those dollars to show up right on time. Back with Sarah and Marco, the second rent isn't dramatic. It's small lines: unit, locker, garage, cloud, parcel, curb. Each one fits. Together they hum like a refrigerator. Always on, easy to ignore until the card expires, and you discover how fast convenience becomes enforcement. The machine prefers you don't notice. You don't have to fight it every day. You just have to see it once and decide which switches you can turn off, and which we should never have wired to profit in the first place. What it means: power, policy, and the price of keeping your past. The lock that clicks at 12:01 isn't just a fee schedule. It's a diagram of power. You own the objects. Someone else owns the switch that decides if you can touch them today. That's the inversion. We used to own the places where our stuff lived: attics, basements, a garage corner. Now we rent the right to remember, and a revenue model sets the terms. Policy lives inside that switch. Lien laws gave owners a fast lane to clear delinquency without a judge. Arbitration clauses moved disputes out of public court. Dynamic pricing stayed invisible because storage never became a lightning rod like housing. When rules are quiet, money gets loud. AI-driven pricing, ECRIs that cross 10%, and fee ladders that feel standard because they're copied in 50 markets. That's policy by silence. What would a different map look like? Start with transparency. Require plain English price boards that display teaser rates, average effective rents, and the total potential fee stack on one page. Mandate ECRI disclosures: how often, how much, by unit size last. 12 months. Put that on the website and at the kiosk. The AI-driven RMS can still nudge. The customer gets to see the hand. Then time. Lock in minimum notice periods for existing customer increases. 90 days, 1 raise per year, emergency exceptions defined in law, not in software. Pair that with a cooling-off window before a digital overlock, 24 hours after a declined debit. It won't erase bills. It restores a human margin inside a machine that never sleeps. Solution: urgency by design, guardrails by policy. Fix the lien lane where it cuts deepest. Modernize statutes to require multi-channel notice, mail, email, text, and photo catalogs before sale. Carve out disaster protections, deployments, and medical crises with automatic pauses. Add pre-sale mediation for units flagged with obvious sentimental content, baby gear, urns, military memorabilia, so someone can triage what shouldn't be priced by the pound. Target the add-ons. Ban mandatory insurance tying. If a policy is offered, it must compete with outside options and disclose exclusions on a single card: vermin, mold, moisture, in 14-point font. Require opt-in for autopay and one-click opt-out. Outlaw junk fees dressed as admin when they duplicate normal operating costs. A clean bill is a fair bill. Shift oversight from box checking to outcomes. Fund independent consumer advocates who can audit RMS practices, mystery shop teaser funnels, and publish quarterly scorecards. ECRI frequency, denial rates, lien speed, security incidents. Tie a sliver of allowed return to service metrics, repair times, claim resolution, cleanliness. So cutting labor isn't the default lever when debt costs rise. Competition won't fix everything, but it helps. Make zoning rules consistent so new, well-run sites can enter instead of defending scarcity that props prices. Pilot community ownership where it pencils. Co-ops and land trusts that accept reasonable returns in exchange for predictable terms. Require guardrails in public land RFPs. Rate caps tied to CPI, bilingual notices, and hardship committees with real authority. Antitrust isn't a silver bullet, but it isn't irrelevant. Consolidation below classic monopoly thresholds can still rhyme across software. Regulators can ask how data sharing and common vendors create coordinated outcomes without a call. At minimum, force post-merger transparency and local market divestitures where portfolios control a radius in all but name. Promise kept, policy-level fixes that match the playbook. Most of this is boring. That's the point. Boredom is where power hides. Contracts at kiosks. Fee tables nobody reads. Notices that look like junk mail. If policy puts sunlight on the lines that matter, the price board, the lien clock, the lock switch, then people can plan. The dividend machine still runs. It runs with guardrails. Back in Sarah and Marco's hallway, the choice was small. Keep paying the second rent or claw back enough shelves to cancel 1 meter. They didn't topple a model. They changed a Saturday. The rest of us decide whether the price of keeping our past is negotiated in public or in a dashboard. The lock will keep clicking. The question is who sets the clock. In a country that sold basements for dividends, we turned memory into a meter and handed the switch to software. If you felt that click in your own life, don't look away. Problem named. Urgency set. Promise made. Solution in your hands. Subscribe for more reporting on how everyday bills become Wall Street income. And watch our next investigation on water and land, the other places where permanent rent hides behind convenience.